Thank you so much for coming. My name is Jane Nakano. I'm Senior Fellow with CSIS Energy and National Security Program. And I am delighted to, on behalf of the Energy Program, to welcome Costanza Jacazio. She's the Senior Gas Expert in the Gas, Coal, and Power Market Divisions at the IEA. And she's here to present the IEA's Midterm Gas Market Report 2016. The report, as you may know, is part of the annual reports that the IEA publishes and gives a detailed analysis and 5-year projections of natural gas demand, supply, and trade developments. This year's report comes at a very interesting time. It's a time of oversupply and low prices. The report does examine the interaction of these developments, oversupply, low prices, and also upstream capital expenditure cuts. The report also gives special attention to the impact on the global gas markets of changing trade patterns and price mechanisms. Excuse me, Costanza has been with IEA since November 2014, and prior to that, she was head of macro and fuel analysis at the Fortum, which is a large utility in the Nordics. And her other professional experiences include a senior energy strategist position in Barclays Capital Commodities Research between 2006 and 2011, as well as a gas economist position in BP between 2004 and 2006. Generally, I invite speakers for this, ask her to speak for maybe 40 to 45 minutes. And then I will start with a couple of questions and then open up the floor for discussion and exchange with the audience. Since today's session is webcasted or live televised or casted, I ask everyone to wait for the microphone once the Q&A period starts. But without further ado, Costanza, please. Thank you.
So I hope that between my cold and my accent, you will still be able to understand what I'm saying, but hopefully the slides will help you in that. So we spend the next few minutes to try to summarize the key results, the key messages of the report, and I'm happy to, of course, take questions afterwards. Do we have a pointer? All right. The key message of the report is that global gas demand growth is set to weaken. Here you can see the average global growth in gas demand. Between 2015 and 2021, we expect growth of around 1.5%. This is substantially weaker, of course, compared to the previous period and also compared to the 10 years average, where growth was around 2.3%, and is also a substantial downwards revision compared to what we were forecasting last year, of around 115 BCM. Now, where does this weakness come from? What are the key factors that are impacting the rate of growth of gas demand? I think we can identify two major issues which are impacting the outlook for gas. The first one is not really gas specific, but is a general slowdown in primary energy demand growth due to a number of factors: the economic and energy transformation of China, the slowdown in demand from energy-intensive economies such as the Middle East and Russia, the weakening link between electricity generation growth and economic growth in advanced economy, which has now become very evident post-2008, which is all contributing to slower primary energy demand growth. So coal demand weakens, oil demand weakens, which basically means that although gas demand grows slower than it did in the past, still maintains its share in the energy mix. And in fact, we are expecting it to increase it slightly by 2021. The second main reason for the slowdown or the projected slowdown is much more gas specific. And it's really about the difficulty for gas to compete effectively in a system where total generation growth in the power generation system is growing more slowly. And you have very cheap coal price on the one hand, and a continued robust deployment of renewables on the other, supported by the combination of falling cost of renewables and continued policy support. So for the first time in a long time, we are actually going to see gas demand in the power sector to grow more slowly than total gas demand, which is a reversal from the long-standing trend where gas demand in the power sector has actually led total gas demand growth. Now, if we do look and we take a regional perspective and we think what are the major changes from a country or regional point of view over the next 5 years, we can identify some interesting trend. So this shows in BCM the incremental demand from different countries or different regions between 2009 and 2015. And you can see how the United States dominated the increase in global gas demand growth, followed by China and the Middle East. This is what we forecast for the next 6 years. And I think there are two things that I would like to highlight in particular. The first is the consolidation of China as a major demand growth driver. This might look a little bit contradictory with what we had experienced in 2015 when China demand growth was at about 4%, which was the slowest pace of growth since 1998. We do expect China demand growth to rebound at an annual average of around 9%, so substantially stronger than what we did see last year. We believe last year there were temporary factors impacting the growth of demand, mainly a loss of competitiveness of gas prices versus oil prices domestically in China, given the fact that domestic oil prices are adjusted much more timely with international benchmarks compared to what actually is occurring with gas prices. So last year, gas prices were adjusted substantially only in November 2015 by roughly 30%, which meant that through most of the year, gas prices, gas markets, gas prices were actually uncompetitive versus oil. And this was reflected in a substantial decline or slowdown in gas consumption in the industrial sector, where LPG demand actually increased very, very strongly. So we expect with the bottoming out of the oil market and with some of these differences in the frequency of adjustments between gas and oil unwinding, some of the weakness in demand in 2015 to actually be unwound and for gas demand to rebound a bit in 2016. Beyond this oil to gas competition factor, I think there is something more structural which is linked to gas to coal substitution more generally as a consequence of environmental policies in China. So last year, actually the province, the city that did perform relatively well from a gas consumption perspective was Beijing, where we have seen indeed many of the more stringent environmental policies taking place. So to the extent that some of these policies keep spreading, the potential for coal to gas substitution from the power sector, but I would say even more from the industrial sector, residential sector, small decentralized coal boilers is actually huge. So we expect this trend to continue and to intensify over the next 5 to 6 years, which will at a great extent offset the loss in demand due to a slowdown in industrial consumption and industrial activity more generally as a consequence of the economic slowdown and economic transformation that China is undergoing. The other key point to highlight, which I think it's pretty clear from the picture, is the change in position of the United States as a key driver of demand growth. So we expect demand growth of about 25 BCM between 2015 and 2021, which is substantially slower than what experienced in the previous 6 years. And again, here there are some structural factors. We believe that the US is on the verge to experience what has already occurred in Europe, where the total small increments, small increases in total generation growth are more than offset by the deployment of low carbon sources. So what this actually means is that coal and gas generation combined with actually contracts. Again, so what this means that yes, there will be coal to gas substitution as a result of the closure of a lot of coal-fired capacity, but because coal plus gas combined decrease, and because gas consumption in 2015 was so high as a result of massive coal to gas switching due to the very low US gas prices last year, we expect demand in gas demand in the power sector to stagnate at best between now and 2021. So that will be a substantial change compared to the previous 6 years, which will have reverberations, I would say, on global gas markets and on the US markets in particular. In terms of other key regions, in Europe, we are also going to see substantial changes in trends. Demand in Europe fell quite substantially over the prior 6 years. We now expect what I would define as stabilization. So a small increase led by a slight recovery in the power generation sector, which is triggered by stable generation growth, so relatively flattish overall electricity demand, and a decline in coal-fired generation as a result of closures in coal capacities, which are linked to environmental policy in Europe, and the beginning of some closures in nuclear capacity, although the vast majority of the nuclear closure will occur post-2021. At the same time, particularly in the UK, where we have a carbon price floor, we do see gas fire generation to regain competitiveness versus coal. So much of the increase which is projected in gas consumption in Europe, which is economically driven, will actually occur or is expected to occur in the United Kingdom. This is for Europe. For Korea and Japan, I also like to briefly touch upon these two countries because they had a major impact in driving LNG demand, as I will show in a minute. Between 2009 and 2015, we actually expect the combined demand from Korea and Japan to decline between 2015 and 2021. This, of course, is predominantly driven by expectation of return of some nuclear capacity in Japan, but also a much flatter demand growth profile in both Japan and Korea, again, driven by that weakening linkage between total generation growth and economic growth that we are pretty much seeing in all advanced economies. So moving now to the production side, what are the key changes in regions? Again, this shows the overall incremental growth by country or region between 2009 and 2015. Clearly strong dominance by the United States. And this shows what we do expect to occur between 2016 and 2021. I think the major takeaway from me is that we are going to see a shift in production growth from a number of established exporters like Qatar, Russia, and ASEAN countries towards the United States and Australia. Now, if we do take Qatar, Russia, and ASEAN countries together, between 2009 and 2015, they accounted for almost a third of incremental production growth. Now the combined share falls to roughly 5%. There are different reasons clearly impacting or driving the slowdown in growth from these regions. In Qatar is clearly a choice, a policy choice to limit expansion in North Field development and new LNG plants. In Russia, it's very much due to the weakness of the Russian domestic market and the weakness in the majority of key export markets for Russia, predominantly the former Soviet Union countries and the exports markets in Europe. For ASEAN, I think it's very much linked to a relatively failure of keeping up investment to the extent needed to maintain continued production growth in both Malaysia and Indonesia, but I would argue also in countries such as Thailand, the Philippines, which in aggregate might not be huge, but do matter and then are going to face production declines from now to 2021. On the other hand, we have United States and Australia, which are going to see a decent level of production growth. The key change for the United States is that most of the growth will actually go to feed export markets compared to the previous period where most of the growth was feeding into relatively strong domestic demand growth. For Australia, we have 7 big LNG projects which have just started or about to start, and that will drive the growth. So in Australia, the vast majority of the growth is export-oriented. So we take United States and Australia combined, 80% of that growth actually go to feed LNG exports. So this shift, I would say, in where growth comes from will have substantial consequence for trade as well. As I said, most of these impact major exporters. In Europe, we expect European gas production to continue to decline. These forecasts are based on the assumption that current caps on Groningen production in the Netherlands will remain unchanged. Of course, there is a high uncertainty whether that will be the case or not. But overall, decline from the continental shelf in the UK and from North Sea production more generally will continue to drive the decline in production. Now, let's zoom for a moment on the US, which clearly is one of the key dynamic for production growth of the next 6 years. So this is how we expect gas production to perform in the US over the next 6 years and relative to the recent history. So we basically expect production to stagnate in 2016, 2017, perhaps a small fall in 2016, mainly led by the decline in associated gas production. So what actually is produced in conjunction with LTO production mainly. We still expect also slower growth elsewhere as gas prices fell to very low level to rebalance an oversupply market. Now going forward, as the IEA does expect a gradual tightening in oil markets and a gradual recovery in oil prices, the heavy lifting of additional gas production over the next 6 years should be done by the associated gas production. So at the same time, probably moderate price increases compared to the extremely low level of 2015 might generate some additional production from more dry or let's say wet gas plays such as the Marcellus and Utica. So the bottom line is that as the oil markets start rebalancing and some of the a huge overhang in the gas market that had developed through 2014 really start to be eaten, then we do expect gas production in the US to start to ramp up again. And by 2021, between 2015 and 2021, we expect US gas production to really account for 1/3 of global production growth. So that's clearly a huge driver for the overall gas markets in general. And it just shows the combined trend overall, so significant recovery from 2018 onwards. Now, what all this means in terms of implications for other regions. I think one of the key implications of continued strong growth in production and generally oversupply in LNG markets will be greater price competition in Europe. So traditionally, unwanted LNG supplies had basically been absorbed by the European markets, which had sort of been played as a market of last resort, given the, I would say, decent level of liquidity of their spot markets and relatively high level of flexibility of its gas system overall. Now, this time around, I think that because of the relatively anemic baseline demand growth on the one hand, very low coal prices on the other, and the presence of potentially relatively low-cost Russian supplies, there might be a limit to how much the region can take in terms of additional LNG volumes. What this slide shows is what would be the cost of sending US LNG into the European markets based on cash costs. So taking off the cost of tolling, which is basically sunk cost for the vast majority of LNG production that is currently under construction, which I think is in the region of 85 BCM. So for the capacity which has already long-term reservation contract, the tolling fee is mainly a sunk cost. So what really matters in terms of potential price into Europe is the price of Henry Hub, which is used here. This is based on the forward curve as of beginning of June or end of, yes, as the beginning of June, plus freight transportation costs and regasification fees into Europe. So at the moment, at least the beginning of June, US would land economically in Europe at a price below the current spot TTF price, which is the major pricing benchmark in Europe, and the forward price for TTF. Of course, currently there has been still a very limited amount of LNG being brought on stream. Again, as that start to expand, the chances for more price competition in Europe to develop will increase due to the substantial quantities of volume which will try to find their way into Europe at what currently is expected to be a relatively low prices. So of course, this will put pressure on established suppliers into Europe to price their gas more flexibly and more competitively than in the past to respond if they decide to defend market share in the continent. Now, what about LNG markets specifically? This shows the increase in liquefaction capacity. Between 2009 and 2015, we did have somewhere in the region of 90 BCM of additional capacity. And this is what we do expect to come to market between 2015 and 2021. The vast majority will clearly come from the United States and Australia, plus some limited volumes from a few other countries. Now, despite low oil and gas prices, we don't expect this capacity to be in any way affected, the execution of these projects to be meaningfully affected due to the fact that most of that, again, is underpinned by either long-term capacity reservation contracts or, like in the case of the United States, which do tend to follow a tolling model, or is an advanced stage of developments, like in the case of integrated LNG projects in Australia. So of course, we might experience some slippages and small delays, which are very much in the tradition of the LNG industry. But I think outright cancellation of this project at this point will be very difficult. So this capacity more or less will come to the market. We are talking about an increase of 45% compared to the level of 2015. So it's a huge, massive expansion, which will have consequences in the degree of interconnectivity of markets. It will also bring substantial new supplies from new producers and exporters, such as the United States, which will tend to, I would say, result in more an increased level of flexibility in pricing of LNG supplies due to the very particular pricing system that LNG supplies actually follow. So this will have substantial implications for trade, both in terms of volumes and in terms of pricing. Now, who is going to take all this gas? This is the other very relevant question. And so here we show who did take the gas between 2009 and 2015. And one of the key takeaway that 45% of the net incremental imports actually came from Japan and Korea between 2009 and 2015. OECD Europe, on the other hand, or EU, on the other hand, so its imports declining, partly due to this redirection of volumes from Europe to the higher-priced Asian markets. But what we expect between 2015 and 2021 is a very different market behavior. So we expect Korean and Japan LNG imports to actually decline. And this is a consequence, as I said, of relatively weak domestic demand in Japan in particular, and weaker than expected, I would say, in Korea, which basically means that somebody else will need to take these additional supplies coming onto the market. Now, as I mentioned, Europe does have some absorption capabilities, but again, they are somewhat limited relatively to the order of magnitude of new supplies coming onto the market. We are already factoring around 30 BCM of new LNG supplies feeding into the European market. This means that all the rest of volumes will need to be taken basically from developing Asia. What about Latin America? What about the Middle East? These are potentially important growth pockets for demand, but it's difficult to see them as base load home markets for most of the LNG. Most of the LNG into this market tend to be seasonal in nature, linked to the performance of hydro production in some countries, such as Brazil. So of course that might grow, but it's unlikely to be transformative or taking the vast majority of new supplies coming to the market. So really the question is whether or not developing Asia will be able to absorb all these new LNG supplies. In our assumption, we do still have a relatively strong growth from China, a relatively strong growth from other developing Asia. We have seen over the past 12, 18 months some positive sign in terms of opening up new markets. We did see Pakistan come into the market, being able also to sign contracts with the like of Qatar, which clearly was a new thing. Egypt coming to the market and fulfill some of its demand shortages via importing new gas through FSRU facilities. As prices stay low, and we do expect global prices to remain under pressure due to this fundamental development, this should facilitate the ability of, I would say, less obvious growth markets to come and partly help to absorb the supply glut. Clearly, I would raise here one of the potential risk factors is China, as I said before. Of course, we do still have a 9% growth average from Chinese demand. Last year was 4%. if China does grow at 4%, if we were wrong in our forecast, and then Chinese demand doesn't recover the way we are currently factoring, of course, China will barely need to import additional LNG throughout the entire forecast period. So this will really raise questions in terms of how fast the market can balance. So I would point out the demand performance in China as one of the major risk factors to this outlook. Now, even in this way, even assuming a substantial acceleration in LNG import growth in less obvious destination markets, such as most of developing Asia, we still expect the utilization rate of liquefaction infrastructure to remain underutilized. So what this chart shows is that utilization of liquefaction plants, once we have accounted for things like plants that are offline due to technical issues, plants that are offline due to security challenges, and feed gas issues. So plants that are there, the still is on the ground, but they are not running simply because the gas is not there to feed those plants. Unsurprisingly, between 2011 and 2014, the average utilization of the liquefaction fleet was very high, close to 95%, which is what you would expect for plants which have relatively low operating costs and very high capital costs. Now, to balance out the market with our demand assumptions and supply assumptions, we need to have the economic utilization of LNG plants to actually go down, meaning there will be some plants that will not run, not just because the gas is not there or because the plant has been blown out, but because might either not make economic sense or the customer simply will not call on the liquefaction contractual capacity that is entitled to. Of course, we are going to see an improvement in this outlook. We currently expect the worst to be around 2018. Of course, there is a huge level of uncertainty. I would not really fixate myself on 2017 or 2018. But overall, we do expect then, as the rate of new additions slows and the potential for demand and pockets of demand as new FSRU are put in place and the infrastructure is added to shows up, and as prices stay low for a relatively long period of time, then we do expect the utilization rate to recover. Basically, the markets, the global LNG markets, to start to move back into balance. Although by 2021, we don't expect the utilization level to be as high as in the 2011-2014 period, which basically means we don't expect the LNG markets to be as tight as it was used to be in that time frame. Now, this, I guess, is the baseline picture, and I think we always need to ask what could go wrong, what could be different, what could develop differently. Clearly, is a relatively bearish picture, is a picture of oversupply for a certain number of years, and I'd like to highlight probably two things which need to be kept in mind when, I would say, digesting this baseline forecast. The first is that over the past 5 years, we have seen a growing trend of LNG capacity being offline due to a variety of different factors, security issues and civil wars and technical issues, and deterioration in the ability of some exporting countries to maintain their own upstream production to the level needed to feed these plants, which is pretty clear, and the capacity of line is estimated to have tripled basically over the 5-year period. By the way, this was a 5-year period where, perhaps with the exception of 2015, was a high price period. So I think the likelihood for something to go wrong in an environment of low prices is certainly on the rise rather than being declining. And I would add that as an important risk factor to our forecast, which clearly don't factor a substantial deterioration in the number and the quantity of liquefaction capacity, which will be offline. The other key thing to keep in mind is the impact of prices on investments. So this chart here shows, excuse me, this chart here shows the average quantity of liquefaction capacity, FID, between 2011 and 2014 on average. We were in the range of 35 BCM of capacity being FID. So quite a number of trains each year were taking final investment decision. 2015, so the quantity FID is starting to come down. I would argue that the vast majority of what was FID in 2015 was in the US and was underpinned by contracts basically signed well ahead of 2015. So the true impact of lower prices on LNG investments had not really come through yet in 2015. And so in 2016, to date, I should say to beginning of June, because I'm not following the news every single day, but to my knowledge, this is still all true. We really didn't see any new FID being taken. So, of course, I mean, we are still halfway through the year, but this paints the picture of how dramatic the fall in investments has been so far as a consequence of the much lower price environment and the substantial capex cut that the vast majority of the oil and gas industry has gone through. So this, of course, might well not be an element that can quickly rebalance the market over the next 3 to 5 years. But when we do start to get into the 20s, if we do have a period of time of very low investment, that clearly will have consequences, how the balance, perhaps not by 2021, but between 2021 and 2025, will actually develop and unfold. So just to conclude, I think the gas landscape is clearly changing. Production growth is increasingly driven by the US and Australia, and that production growth is increasingly going to feed demand from other markets, so it's increasingly going to feed exports. At the same time, demand growth, it's really going to be driven by developing Asia, and the difference on how fast global gas markets will be rebalanced really hinge on your view on developing Asia. Now, traditional exporters will come under pressure as competition from new supply sources intensifies. This is true from Europe. I specifically highlighted the implication of that region, but I think this will be very true for other producers more generally in the LNG space. I think traditional exporters, which do sell their gas on a typical oil linkage basis, will come under increased pressure to introduce more flexibility in their contracts, to potentially lower tenures, to potentially add some spot indexation, as the buyers are looking for, I think, two things. One, of course, lowering their overall costs in a market which is oversupply, and the other thing, to respond to less certainty over their demand outlook. One of the key elements of the past 5 years, the many established Asian buyers ultimately ended up to be overcontracted. So they started from assumption that demand trends which were overly optimistic. And as, of course, these forecasts have proved wrong, there will be an increase, I think, a search for more flexibility to where the actual baseline levels might end up. At the same time, also, you need to consider that we are really seeing a transition from secure baseload, long-term demand from credit-worthy counterparts such as Japan, and Korea towards more uncertain, smaller and more numerous demand pockets, often from much less creditworthy counterparts. And so this really will require some changes in the way the overall business models actually does work. Global gas prices are set to stay under pressure as a huge amount of LNG export capacity is coming online, just as demand slows. Of course, there will still be a linkage to how oil prices will develop, particularly in Asia. But because of the oversupply in these spot markets, there will be an increased pressure for the linkage to be weakened at some extent, and for global gas prices to be somehow more closely interlinked. Lower prices have triggered a collapse in new investments, and this clearly could see the seeds for tighter markets into the next decade on the one hand. And I would add to these bullet points, we should really closely watch the consequences of much lower prices on capacity that might ultimately go offline due to a number of different reasons, from lower upstream investments to security concerns in a number of countries. So I will stop here, and I will happy to engage in questions and debate. Thank you very much for your attention.
Thank you so much, Costanza. And obviously, despite having a cold or, sort of recovering from it, you did a fantastic job. And, obviously you can tell that, aside from the fact that we both enjoy following the global gas market trends, we also share this whole, the current, the sort of struggle to recover from a cold. But we won't let that interfere with our this session. While you try to rest your voice, I suppose, I have a couple questions. I mean, I can ask you a lot of questions, but in the interest of time, I certainly want to save some time to take questions from the audience. Let me ask you 3 questions. One concerns supply side, one concerns the demand side, and I guess the third concerns, the price level, if you will. The supply side is Iran. I mean, that's the one sort of big player. And as Iran is, is coming back to the global market, what's your perspective on their potential as a gas exporter? And would it be mainly as a pipeline exporter or LNG? What are some of the sort of building blocks that they need to be able to take advantage of their resource wealth? The demand side question is, we talked about the sort of a power market quite a bit, and certainly gas faces competition from nuclear and coal, particularly in Asia, but then even in Europe, coal is pretty competitive. Of course, renewable continues to get government support. And when it comes to non-energy sector, for quite a while at these types of sessions, we talked quite a bit about the potential in the transportation sector. Where is the prospect? I mean, how does the prospect look like today? The potential as bunker fuel. And then the third question concerns your graph on the greater competition that's coming to the European gas market. So I guess you talked about how the U.S. Assumption is based on the assumption is that the price level is the cash cost, because we're considering the initial investment as like sunken cost and et cetera. But I guess in the longer run, though, these companies still have to be able to recover or get, at some point, they need money to be able to reinvest. So, I guess the assumption under the cash cost, to me, can't really go on for a long time. So I guess it's more of a clarifying question. But have you guys run a model that's based on the U.S. U.S. price that That's not just the cash base, but including the whole range. So that's my third question. So thanks.
Thank you, Ina. Very good question. So, in the case of Iran, I think first comments I would make is that the gas situation is very different from the old situation when it comes to Iran, because gas production, even before the lifting of sanction, was already at all-time high, while clearly oil production wasn't. So, in the oil markets, you had this period where oil production can bounce back relatively quickly due to the fact that capacity was already there, simply Iran wasn't producing, at least at the level of it could actually have already been able to. So on the gas side, you will need to go straight into new investments, both in the upstream and export infrastructure, to be able to actually substantially increase production levels. So this is the first important differences. And although, of course, there is a perception that companies are happy to start to engage with Iran, I think the current low price environment and the lack of full clarity on the contract structures of some of the Iranian new potential contracts will mean that companies and banks will most likely re-engage cautiously into the country. Also, Iran does have a potential very large domestic market to be tapped into to start with. I think the period of sanctions have impacted its ability to export, for example, petrochemical products. So we could really see a period where demand and domestic demand is an initial beneficiary of the re-engagement with international companies before exports really start to be developed. And also, I think Iran faces the challenges of any other major potential LNG exporting region, which is companies are cutting costs. So, the investment slide that I showed, clearly it's a global chart, but shows how challenging it is for companies to take investment decisions in the current price environment. And Iran will still, will face basically similar challenges from the investment side. So that's for Iran. When it comes to demand. Yes, so we do tend to focus a lot on the power sector dynamics because I think are the ones that are evolving more quickly and where most of the downward adjustments actually have been. And because so much was somehow placed on the expectation that the power sector would have driven demand growth, particularly in Asia. And that is where really we haven't seen that happening, at least at the extent that many, from the company perspective and analytical perspective, were expecting. That's why most of the focus of the presentation is on the power sector. Of course, there are options and there are growth potential in other markets as well. But I would say it's difficult to imagine, particularly in a 5-year, 6-year frame, any of the other markets to be able to offset or compensate for the lack of growth of the or the lack of enough growth in the power sector. I think in the bunker fuels, the marine, we are seeing encouraging developments. But of course, we start from a very small scale. So when we do see what doesn't materialize in the power sectors versus what does materialize in the marine sectors, we are looking at two different orders of magnitude. So in the longer run, that of course could be a very important developed market. When it comes to road transport, I would say probably over the past 18 months, some the very low oil prices have tended to have negative short-term implications for the uptake of both gas and electricity or alternative fuels vehicles. I think in the longer run, again, that is an option, but I think will probably be more still all true for markets which already have a substantial amount of LNG or CNG vehicles, such as India, such as some of the developing Asian markets. Of course, China, we are seeing, and we have been seeing a push. Of course, in the short term, the oil gas competition had an issue, had an impact on that. But I think this market, yes, are pocket of growth. But again, I do think it's going to be a more long-term option rather than a short-term one. And there was another question, sorry.
The U.S. LNG export?
Oh, yeah, that's a very good question. Now, the reason why, of course, you're absolutely right. When we do this, when we make these comparisons, we are comparing something which, of course, does include the return on capital to, let's say, investors, or in the case, I would say, of the U.S. plants. If all U.S. production for the lifetime of that plant will be sold at cash cost basis, this will be a source of value destruction for somebody. Now, who will be let's say, the value destruction will most likely be in the hands of who has signed the long-term capacity contracts mainly, because of course are the ones that do pay the tolling fee. But if we do still have 85 BCM of US gas, for which the cost is sunk, it still need to ramp up years after years for the next 5 years. When it comes to the analysis of what are the implications for Europe or other markets for 5 years or 6 years, I think that is probably what I would try to focus on the most to determine how price formation will look like over the next 6 years, both in Europe and in Asia. That said, I fully agree with you that that is not a sustainable model because in the long run, people are losing money. So nobody will sanction a new project based on a $4 million BTU LNG prices expectations. That's for sure. That's why nobody's actually sanctioning anything at the moment. That said, I also think that even though that, of course, cannot occur and would not occur, from a market perspective, we do have this first wave of 85, or how much is that, I think, around that the quantity of capacity coming online, and consumers perceive the potential that new LNG projects could be sanctioned somewhere higher, but maybe not at the 12, 13, 14, $15 million per BTU, which were required to sanction the previous wave of LNG projects. That again will in itself do help to create more competition, or at least options from a consumer perspective of the longer run. Of course, not at $4 or $5 per million BTU, that's for sure.
Great. Thank you so much. Now I'd like to open the floor for questions. Since this is live casted, please wait for the microphone and state your name and your affiliation, as well as, and please ask your question in the form of a question.
Agnia Grigas, Atlantic Council. I have a broader question for Costanza. Could you comment a little bit or share your thoughts? To what extent you think a global gas market is emerging, or when that could emerge, and what are the hindrances, the main hindrances to it?
Sorry, what are the main?
Hindrances, what blocks to it?
Yes.
And when and if they could be removed. And then on a side to that, to what extent a global gas market do you think would depend on sizable US LNG exports?
That's a very good question. There has been already a lot of discussion whether we are already pretty much in a globalized gas markets due to the collapse in regional spreads that we did see over the past 12 months. So currently, pretty much everything is trading at a transportation cost spread base. And in some cases, not even at that, if you do look at spot gas prices in Asia versus spot gas prices in Europe. So the first question for me is, what has driven this convergence? Is something which is temporary or is something that is structural? I would say a little bit of both. The temporary component is the oversupply situation. So of course, in an oversupply market, it doesn't shock me at all that the regional spread differential is basically based on the transportation cost between regions, if you want to. The other element has been that we did have a simultaneous alignment between fundamental development in the oil markets and fundamental development in the gas markets. So what we did have basically is that oil linkage prices in most of Asia were trading not very far from where spot gas prices were trading this $4, $5, $6 million BTU level. The question for me is, there are two points. The first is, when oil prices will recover, are we going to see the same sort of price convergence that we have been seeing? And keeping in consideration all the new flexible US supplies volumes that are going to come to the market. And I think our overall view is that in Asia in particular, we are going still to see an impact of oil prices on Asian prices over the next 5 to 6 years. Clearly, the tendency will be, with so much more flexible US supplies and still a certain level of oversupply, for the linkage to oil prices to start to come off, or at the very least to weaken compared to what was the case. And this will tend to reduce by itself, the spread between regions where gas price formation is based on gas-to-gas competition, like in the US, and regions where up to now the oil linkage has prevailed. So there will be a tendency towards more, I would say, globalized markets, but I don't think the process will be concluded on a 6-year basis. And even in a perfect globalized market, you will still need to introduce, or you will always have the transportation costs as something which will result in different prices across different regions. But this is true also in the US gas markets. I mean, if you do look at the market trade based on basis spreads, so the fact that you have a different price in New England from a price in Louisiana is pretty normal, and the transportation costs are a big part of how that pricing dynamics work. So I think that element will remain, and of course, as oil prices will recover, we will probably lose some of the extreme convergence that we did see in an extremely oversupply situation. And I would tend to look at the way an oversupply situation is actually priced, looking at how global gas, global spot gas prices trade versus oil linkage prices. So if you do look at the Asian situation, in the recent past, that spread was, relatively narrow. If we do have a situation where oil markets and oil prices start to recover, but gas fundamentum keeps staying extremely weak with growing US supplies into the market, I think the first thing that will happen is that you will tend to have an increased disconnection between spot gas prices and oil linkage prices. And again, renewed tensions between buyers and sellers in terms of how volumes and how new volumes should be priced.
Anyone else? Anyone else? Yes. Yeah.
Peter Murphy from the Noetic Group. Sandra, thank you for your presentation. I'm interested in the drivers that were that informed your study. Global warming, the drive for less intensive carbon economies. How much do you think that's contributing to future demand? And do you see that changing over the lifetime of the study that you've done?
Yes. And now another very good question. I think actually one of the key questions for the industry and the analytical community alike. And the most widespread questions I get is, what's the role of gas in the future energy mix? Which goes back to how all the climate policy and climate commitments will impact the energy mix and the demand for gas. Now, the IEA, before the Paris agreements, we released last June a climate change special report, which did draw on something that we call bridging scenarios, which basically were looking at what could be done and what would need to be done to have early peak in emissions. But some of the measures that were listed there, I think, can help in judging, or at the very least assessing, how the role of gas could change in that energy mix. And I think there are positive and negative drivers for gas demand, from intensifying, let's say, climate change policy or environmental policy more generally. Clearly, one of the measures listed in that scenario was the need for phasing out inefficient coal plants. And this will leave some space for more gas-fired generation potentially. At the same time, we will need to have substantial measures and ratcheting up of measures for energy efficiency, which will tend to lower energy demand growth in general. And again, that will tend to be negative for all fuels and energy demand forms. Then I think we will see a transformation of the role of gas in the energy mix, as the renewables investments also need to be increased, and that will tend to shift the role of gas from a pure base load play to a much more mid-merit, a peak merit load, which again will need to, does raise questions in terms of what business model might work and how buyers and sellers should think about how to reshape potential contracts to take into consideration the substantial changes in dispatching and flexibility needed by consumers in responding to the need for gas to become a sort of a backup option for gas-fired generation. And the third one, the last one, of course, was the need for controlling methane emissions, which generally is something which might indeed play in the role that the industry and the gas industry can play in addressing climate change. So I think these are all the pieces of the puzzle which will impact how gas demand will play in the energy mix. I would add one more thing, which is clearly gas to coal competition, particularly in the power sector in Asia, will be critical in determining, from a volume term perspective, how much gas demand growth we will see, let's say, over the next 10 or 20 years. What mainly got wrong over the past 5 years was there was a general expectation that Asia would have taken as much gas as we could produce at whatever sort of price. In the short term of the past couple of years, we haven't really seen such a huge price response yet in Asia to the much lower gas prices. I think the key question is if we are able to deliver gas and new gas supplies at a relatively low prices, which doesn't necessarily need to be economically competitive versus coal, but need to be more closely competitive versus coal. How could that alter the equation for buyers in terms of embracing gas at a certain extent as a long-term strategic option in the energy mix, where the cost differential between gas and coal is substantially reduced? And this goes into one, whether the current low prices environment can be perceived as sustainable. Two, the question that Jane has posed, new supplies, at what cost can actually they be produced, and how lower the overall cost of supplies can actually be? And three, can that dent the long-term, or can that change, or can that shape the long-term strategic choices of countries as they do become more environmental aware and as they do try to sort of address some of the climate change issues? So I don't really have an answer for all these questions, but at the very least, I try to list them.
If I may, I'd like to follow up a little bit on this sort of a climate or carbon angle. I'm just curious, I guess, not so much to put you on the spot as an IEA person, but maybe as a European sort of a gas analyst. the social license issue. Well, it's not. I guess in the U.S., we do talk about earlier on in this so-called shale gas revolution, we had the we try to understand the impact on drinking water and etc. And then now we're looking at the methane emissions issue. And in the meantime, I guess in Europe, we noticed that there is this movement not to import fracked gas from the U.S., etc. Do you think that's something that you think may continue, that sort of a social sort of opposition to gas imports into Europe?
I mean, I think there are this goes back to the overall European position on shale gas generally. And I think there are, when it comes to the production side, there has been a number of different reasons why shale gas have failed to really take off in Europe. Part of that is actually due to how the economics stack up, because I would say that the cost of fracking gas in the US and importing it into Europe is a formidable competitor to producing shale gas in Europe, given the geological and industry differences across the entire supply chain of the industry in Europe. So this is one important difference. The second is, of course, the environmental concerns that I would say have been generally stronger in Europe versus in the US. And I think generally, we do think that some of these concerns are legitimate. At the same time, is a reason why the IEA has put out these golden rules in terms of how shale gas development should take place following a certain number of environmental guidelines. So that could add a small cost, but of course being very important in making sure that both methane leakage are somewhat addressed, and at the same time environmental risks are substantially minimized. So in that sense, I would say that you can't control you can't control what concerns are, but you certainly can, you can inform of what the risks are and what the potential way to address those risks are. And so from our point of view, with the right set of environmental rules, fracking is something that certainly has also its benefits.
Bob Eichord, Atlantic Council. I'd be interested in your take on China in terms of its policies toward both diversification of gas imports, in terms of LNG on one hand and Turkmenistan and Russia on the other hand, and sort of how you see them looking at dealing with the problems that they have now with a huge surplus capacity in the gas import facilities.
Yes, that's another very good question. In terms of, I'm just thinking where to start and how to keep the answer short. I think in terms of diversification options, of course, we have, let's say, import options. We have LNG, we have Russia, and we have Turkmenistan, let's say, Central Asian countries more generally. I think from the Russian side, what we clearly saw is power Siberia is coming on and probably will come on. Of course, the likelihood of delays compared to the more accelerated or base case line is increasing due to both, some ongoing delays probably from the Russian side in proceeding with investments at the pace that originally thought to, which is perfectly understandable considering the much lower oil gas prices and investment challenges that generally they are facing. And on the other hand, that goes hand in hand with the current oversupply of the Chinese gas markets and a much less urgency from the Chinese side to actually get their supplies at a very early stage. Now, given the deal is there, given that some construction has occurred, some tendering has occurred, and there is some strategic significance in that sort of diversification from both sides, I think it makes sense to assume that will probably proceed. In fact, we do have that embedded in our assumptions and forecasts, albeit the startup is very late in the period with very small volumes. When it comes to Turkmenistan, again, I think in the long run, first of all, Turkmenistan is already a substantial exporter to China. I think it makes sense to think that we are going to see, a gradual increase over time of exports from Turkmenistan to China, albeit again with a delay, most likely, particularly in the ramp-up of Line D from Turkmenistan to China. But I think that direction seems to me, pretty clear in the longer run. The most likely, of course, we are going to have fluctuations in the quantities sold by Turkmenistan to China or LNG import taken by China, depending on short-term price differential within the limits set by the contractual obligations that China has signed. But in terms of trend, I think we're going to keep seeing Turkmenistan export to China increasing. When it comes to the LNG market, it's interesting, clearly, because, as you said, we did have a number of companies over-contracted, particularly in the short term, in terms of volumes. What we have already seen is that some companies have taken action to try to resell some of those volumes into the spot markets. Of course, this requires some sort of negotiation with the suppliers in terms of what is allowed and where things can be sold. Probably we might see some volumes being deferred in terms of when they are taken. And I also wouldn't be surprised to see companies or state-owned companies be more, I would say, more engaged in trying to push some of the gas downstream more aggressively than they have done in the past, based on the fact that currently are sitting on long-term portfolio, long portfolio, long trading portfolio that do require some active management of those volumes. It was very different when you are in a position where actually your portfolio is what I would say short or balanced. So of course you can chase pockets of demand within your domestic markets outside your sort of area of comfort that might bring you some additional revenues, but doesn't actually generate, you're not sitting on a position that can actually generate loss. So I wouldn't be surprised to see a more active behavior to try to stimulate some of that potential demand that is there that does need to be unlocked, which in terms of volumes, the length they are sitting on is not huge compared to the potential that the market does offer. So alternative they will pick and how they will manage that between falling spot markets, selling the spot market, renegotiating with suppliers, chasing pockets of demand. Of course, it's very difficult to pinpoint, but I think they will probably try to operate across entire possibilities on toolkit they actually have.
Sure. Agnia Grigas again, another question. What risks do you see to the ability of the U.S. to maintain its production and sizable production and sizable LNG exports, maybe in terms of domestic politics or potentially the risks to reduced investment due to oversupply in the markets or so on? Thank you.
mean, in our current forecast, because of the substantial fall in drilling activity, both on the oil side and on the gas side that we did see since really Q3 2014 up to May, we are already seeing, in fact, I would say in the US is the place where you are seeing that occurring much faster due to the very short lead time between investments and production, due to the normal nature of unconventional drilling. So currently we are starting to really see the impact of production coming off as drilling activity has, we are starting to see it. I mean, of course, I would say if we were asking, I mean, one thing to keep in mind, to bear in mind, has been that falling oil production and flattening gas production is a remarkable achievement and a testament to the financial and technological resilience of the shale industry in the US, considering the extent of the fall in investment and drilling activity that we did see. But at one point, I mean, there are some shale plays where the rig count is at 0. I would expect production to come off. So that certainly is starting to impact. Now, because, I mean, the question, of course, is how fast, the activity will resume as prices, particularly on the oil side, started to recover. Because, of course, in the gas market, is the same story. Because, of course, price has also been remarkably low, and the reason why that activity has come off is precisely because of the need to rebalance the oil and gas markets. So, of course, as prices start to recover somewhat, then drilling activity will resume. And the question that we don't really know exactly, because of the wave of shocks through which the industry, has been exposed, is, for any rig that come back to the market, how much production you're going to generate. Because, of course, company has lash cost substantial on the one hand. On the other hand, you keep seeing like improvement in efficiency in drilling. So calibrating and balancing out how the recovery will be due to all the changes in all these different parameters that we have experienced in the way down, I think is very, very difficult to judge. Our sense and our modeling work does still show that you can have a substantial recovery in production, as shown in my slides, with limited upward pressure in prices compared to the current price levels. So the outlook that we gave, we don't have price forecast in the IEA, so we don't run price forecasts, but we utilize assumptions to inform that demand and supply balances. That sort of production growth is still consistent with the price range of 3.5 to 4 by 2021. So, of course, I would say limited price increases considering the additional volumes that we are still forecasting to occur. Because perhaps another element to feed your question is, because of much smaller expectation for demand growth from the United States, I think the performance of international markets, both from the upstream side and from the demand side and export call, will have much bigger implications for the dynamism of the US gas markets compared to what was the case when the gas market in the US was a sort of quasi-island, because of course you always had a lot of interaction with Canada and Mexico, but certainly did not have this feed through, Asian markets and European markets. So I think that will be something that on the margin will start to matter much more for the US gas market than it did in the past.
Last question.
Victoria Zaretsky, Energy Information Administration. There is a lot of activity currently going on building natural gas hubs in Asia, in Japan, Shanghai, China, and in Singapore. Of those 3 countries, which country do you think is most likely to build a successful gas hub? That's question 1. And second question, about 50% US liquefaction capacity contracted has flexibility and destination clauses. Which countries do you think would be the beneficiaries of...
Sorry, 50% of?
Contracted capacity has flexibility...
From where?
from the US has flexibility and destination clauses. Which countries do you think would be the beneficiaries or the recipients of the US LNG that has this flexibility and destination clauses? Thank you.
Thank you. In terms of markets, I mean, I don't really have an answer for you in terms of what I think it's most likely. There is a number of pockets of initial, the establishment of potential trading hub for LNG in different countries does remain really to be seen. I think there are potential advantages and disadvantages that all these different places you have named actually have in terms of having domestic demand and supply or having a very well-developed financial/insurance capabilities. So does really remain to be seen. I would say that currently, although there has been some improvements and some advances, we are not yet at the point where we do have a well-developed, deep enough markets in any of these regions to become a reliable benchmark at the current stage for LNG transactions. So we did, a couple of years ago, release the IEA, a study in terms of new hubs and developments towards LNG hubs in Asia. And in that, we spend a lot of time looking into Singapore as a potential trading hub due to all the new initiatives that the countries it's putting forward. But even in that report, we highlighted how it might indeed take quite a long time for that things to happen. So that's regarding the trading hubs. Regarding where US LNG, the flexible US LNG will go, in our own models, we don't attribute production from, let's say, one country into particular markets. That said, I think it's reasonable to think that with the vast majority of non-US new supplies coming from Australia and the Pacific Basin, Australia will take up most of the demand growth in the Asia Pacific, and that will lead to more US LNG being pushed towards Europe. That certainly is what I would expect to happen. And in our forecast, we can say that we have around 30 BCM of additional LNG coming into Europe. So I think it's reasonable to think that a good chunk of that will actually come from the United States.
How about Latin America?
I think Latin America is very interesting, but I think in terms, it's a matter of size. I think if you do look at who drove imports growth over the past 6 years, Brazil was clearly one of the biggest markets for LNG in Latin America. But if you look at the demand growth in Brazil, the supply growth coming from current fields under development, which again, because of some of the sunk costs, there are sunk costs, some of the production will come irrespective of the low prices and the difficulty the country is facing. And hydro at one point will likely, at least partially, to return. I think there is a scope for a substantial cutback in Brazilian LNG intakes, which of course means that you have other potential growth areas. I mean, the Caribbean is an area that US producers in particular are looking very closely. You will have potential for higher intakes in Argentina. But again, if you do sum up the volumes, it's difficult to see the Latin American market to come up with substantial volumetrical growth. From a country perspective, they might indeed change the balances a lot. You to take individual little markets.
Enough to aggregate.
But not in aggregates. So I think the realistic answer to the 80 BCM that the US is going to put to the market is that Asia and Europe will need to take the vast majority of it. And I think because of the Australian growth, much will actually ended up to Europe.
Great. I mean, this was a highly informative briefing, and it's a fantastic report. And thank you so much, Costanza,
Thank you for having
coming.
me. Thank you for your
and I hope
attention.
you'll be back next year.